Hello and welcome to the weekly wrap. So firstly I'm just going to start from a UK perspective. So this week of course has been the UK general election. So heading into the results announcement, this election was meant to be one of the closely fought races for Downing Street seen in years, with the final YouGov poll expecting Conservatives to get a modest lead over the Labour Party with around 284 seats, with a required majority being 326. The Conservatives were projected to be quite a bit below this. However, when the final exit poll came out at 10 PM London time last night, we did see cable spike higher by 150 pips. So as the Conservatives were forecast to get 316 seats, which is significantly above any of the projections made by previous opinion polls. So subsequently we did see a relief rally in cable, given that Conservatives typically are good for business, and as well it did also help to alleviate some of the political uncertainty which had been beginning to creep into price action heading into the announcement. And then thereafter we did see some of the key marginal seats get awarded to the Conservatives, with the Conservatives eventually ended up with an overall majority in the UK House of Commons, which is very much against the grain of expectations. So subsequently, from a fixed income perspective, we did see a bit of a relief rally in gilts, so we did see them spike high around 150 ticks. From an equity perspective, given the Conservatives are typically good for business, we did see a rally there as well. And then on a sector-specific basis, we did see gambling names, banking, utility names and home builders all move higher, as they're now not going to be subject to some of those potentially stringent Labour policies. But elsewhere, now just looking further ahead for the UK, so from a rate perspective, given the Conservatives are to implement slightly tighter fiscal policy, this will likely be countered by looser monetary policy by the Bank of England. So we have subsequently seen JP Morgan revise down their rate path for the UK over the next few years. And one other thing just to bear in mind in terms of some potential ramifications, given the Conservatives have won, we could see a potential referendum on the UK's membership in the EU somewhere down the line. However, do note this won't actually necessarily take place for another few years yet, with some suggesting 2017 as the most likely time frame for this. And then in other things that we've seen this week, so we did, of course, today have the release of the US non-farm payrolls. So that headline did come in slightly softer than expected. So it came in at 223,000, below the expected 228. However, focus was on that revision. So the previous, which was a disappointing report itself, revised even lower to reach its lowest level since June 2012. The average hourly earnings components, they did fall short of expectations as well. So just in terms of the overall market reaction, it was more of a Fed play, so we did see Treasuries spike higher, equities also move higher, as well as some softness seen in the US dollar. So it's very much just a Fed play, but just in terms of market expectations, December is still seen as most likely month for the Fed to lift off rates. So than that, just in terms of other things we'll be looking ahead to next week, we'll be looking out for any further comments from Greece. So we do of course have that Eurogroup meeting, which is to take place on the 11th. So heading into that, some of the comments have been relatively encouraging, that saying that talks have progressed. However, it is unclear whether we're likely to see anything too substantial from this meeting. But unless we are also expecting Greece to make that IMF payment next week. So that's all from me, and thank you for watching.